Saya akan share screen. Share. Gambar ni pula. Okay. Sekarang ni, alright. So the topic today, that we will be discussing is on the risk management. Okay, risk management. Okay. So, oops, nak pergi pula ni. So, okay, risk management in the Islamic capital market. Now, when we talk about investment, when we talk about any product or services in the capital market, we also be talking about risk and also the return. Because risk will, if we look at the nature of the concept of Islamic investment, there must be risk, okay, for any of our investment. If there is no risk, then it will not consider as a Sharia compliant product or services. Okay, if there is no risk. So when we talk about risk management, okay, in Islamic capital market, so basically risk is a condition where there is a possibility of adverse deviation from the desired outcome. So basically we are talking about, okay, let's say I expected that when I invest in ASB, okay, I earn, for example, 5%. But if ASB did not give me 5%, it give me 3%, then there is a risk, okay? Because we expect 5%, but we get only 3%. It does not necessarily mean that when there is a negative, even though it is not achieving what we expected, still positive, 3% is still positive, right? But not 5%, so that is actually considered as risk. The 2% is considered as risk, correct? So, each financial product industry have different risk exposure. For example, ASB just now, we can say that we might have a very small risk, okay, because the product and services is being, is protected by the government, right? Or maybe if you are invest in the bank, okay, not invest, you save in the bank, so your money is being protected by PDIM, okay, right? So all the deposit will be protected, okay? So there is no it will be losses in terms of your savings in the bank, okay? But if you invest in the stock market, for example, okay, stock market, there is a risk of higher risk, but there is also will be a possibility of getting higher return. So each financial product and industry have different risk exposure. So if you compare just now, I've given you example, okay, saving in the bank will give you a very low return, but low risk. If you invest in the stock market, high return, but higher risk, okay? High return, but higher risk, okay? All right, so the type of risk exposure can be actually categorized into different type, okay, major type. The first one is financial risk, then we have the operational risk, then we have the business risk and other risks, okay? So sometimes other risk is also quite big, okay, in terms of its impact towards our investment. Example, now, at the moment, this particular moment, we have a parliament hung, right? Parliament tergantung, tertahan. We call it political risk. Okay, political risk. What happened to the market today? It goes down. Okay, the market today goes down by 8 basis points. Okay, 8 basis points. So basically, it is actually lower than the moving average 20 days, right? So it's actually showing that there is a risk. Okay, when the political stability is not there, there will be a risk about our investment and also our financial capital market, right? So let's look at the first risk, which is the financial risk. Okay, financial risk can come from credit risk, liquidity risk, currency risk, interest rate risk, equity price risk, and market risk. Now, these risks are all can affect, okay, the our investment. For example, credit risk. Credit risk is basically if the company, okay, having like a very large credit, okay, and that credit cannot be paid by the debtors. So there will be a credit risk, okay, for that particular thing. Or the company could not pay their borrowers, also a credit risk. Liquidity risk, which is actually whereby the company having lack of cash, okay, in their operation, for example, right? Lack of cash to pay short-term obligation, short-term, what you call it, liabilities. So this is liquidity risk. We have also currency risk. Now our currency has depreciated in value in terms of against US dollar to 4.57, right? 4.57, and then that is actually having an impact towards companies who having import from the US, or who have to pay what I call it, their import in US dollar. So when the US dollar has appreciated in value, you have to pay more, right? You have to pay more. Last time, okay, the currency was 3.8, okay, 3.8. You have, but now it's 4.5 for each dollar. So whenever you import from the outside using dollar, you have to pay the difference of 70 cents. Okay, 70 cents. So you have to pay more. So that's why there is what we call it the currency risk. And then also interest rate risk, whereby you can see that the interest rate, okay, is actually as we have covered in the previous lecture, it is based on the monetary policy of the government or the Bank Negara Malaysia. So now the interest rate is actually has been increased from its lowest of 1.75 to now is 2.75. Okay, so it will be also going up, okay, to maybe 3.5. So what happened when the interest rate increase? So you have to pay more in terms of your financing if you have existing financing, and also if you want to actually to have what I call it loans, okay, for your business. So you have also to pay the cost of fund, which is higher, okay, as compared to the previous lower interest rate interest rate. And then also we have equity price risk, whereby your equity, your share price, for example, goes up and down. And also you have the market risk. This is the market risk which you cannot diversify. It can comes from political risk, it can comes from macroeconomic risk, and so on. Okay, and then we have operational risk, which is the risk that because of our daily operation. Okay, we have Sharia non-compliant risk, people risk, people key in wrong data, something like that, and then fiduciary risk, technological risk, legal risk, and risk of inadequate or fail internal processes. So these are all we call operational risk. Then we also have business risk. Okay, maybe we look at the policy risk, financial infrastructure risk, and systemic or the risk or the country risk, right? And other risks, as I mentioned, we have political, model risk, and also other exogenous risks. Okay, so as I mentioned before, credit risk is a common financial sources, which is basically we get our financing, so from loans, from banks. Okay, so financing basically ability to pay obligation. So if we look at our investment, so ability of investor to honor expected rate of return. So basically, if you are an investor, you basically will want the expected rate of return. For example, if you invest in ESP, you expected to be paid about 5% dividend every year, right? So that is in terms of credit risk. Then we have market risk, the risk of changes due to changes in the market rates. Okay, for example, deposit, funding, changes in rate, investment, changes in the equity prices, and so on. Liquidity risk, okay, if you are a bank, so you will be depending on your deposit and also your funding and also financing, right? So in terms of investment, also the same thing. So whether the company can actually honor the short-term obligation with their short-term assets. Okay. So operational risk basically are common sources come from human errors, fraud, okay, machines, and so on. Okay, Sharia non-compliant risk is also one of the risks in the operational risk which arises from the Islamic failure, sorry, not Islamic failure, from the company's failure to comply with the Sharia rules and also principle determined by the Sharia board of the IIFS or the relevant body in the jurisdiction in which the IIFS operates. So this is in terms of the Islamic banking. But in terms of capital market or stock market, it's based on the SAC, okay, SAC, Sharia Advisory Council jurisdiction, right? And then also we have fiduciary risk. Okay, this is in terms of fiduciary of the company. Okay, whether the company is actually protecting, okay, doing business at the same time actually doing business with honest and also without doing any misrepresentation of the financial statement, okay, without fraud and so on. And then also legal risk if the company is being sued, okay, by any other companies because maybe it arises from non-payment, okay, of this honoring contract, okay. So this is a legal risk, right? So basically we can actually classify the risk of exposure, okay, based on the nature of loss, okay. The nature of loss, it can be internally or externally. The impact of loss, whether it's direct or indirect, okay, the degree of expectancy, whether it is expected or unexpected, and the risk type, okay, event type, loss type, okay, and then the magnitude, severity, and the frequency of loss. So this is, you have to look at this, right? Nature of loss, impact, degree of expectancy, risk type, event type, loss type, and also the magnitude, the severity. If the severity is very, very big, it will have an impact towards the company. For example, I'm going to show you this. Okay, DNAC. Okay, DNAC is actually one example. Okay, DNAC. Okay, so DNAC, okay, there is some issue of what I call it DNAC and also another company which is China-based. Okay, they both have like go for a contract for Silterra, okay, Silterra. And what happens that the DNAC Corporation has issued ICPS, okay, Islamic Convertible Preference Shares. So when the company from China converted the ICPS, what happened is that their shareholding from 60-40, say 64% DNAC and then 40% the company from China, it become China 60, DNAC 40. So what happens that DNAC, okay, has some problem or the issue of it is not anymore a local company. It is becoming a foreign company. So what happened to DNAC? It has you can see that at the previous Friday the price jumped down. Okay, the price jumped down. Okay, this one. Okay, the price jumped down because of the risk. If, for example, that project is not being honored because of the issue of technicality. So what happened is that from the price of 75 cents, it goes down to 45.5 cents. Before now, today is actually 59.5. Okay, so you see, because there is a risk and the severity is big. Okay, because if the DNAC cannot get that project, okay, the severity is big. That's why there is a reaction from the market to sell the product. Okay, to sell the product. Okay. All right. And then, so the magnitude, severity, and frequency of loss is actually very important aspect also if we want to see whether the risk is actually having a big impact towards the company. So the loss, okay, we actually look at how we calculate the expected loss. It's actually this, okay, event losses we multiply with the likelihood of loss, okay, the probability, okay, of loss, okay. Okay, let's look at the risk identification process. Now, for the risk identification process, the first step here, the first step is that actually you have to identify the risk, okay? Identify the risk. Okay, what will be the hazards, events, consequences, right? Hazard, events, and then consequences. Then for step 2 is to measure, step 3 to mitigate, and step 4 to monitor, right? Okay, so if you look at the hazards here, what did not happen? Okay, so basically A, okay, inadequate employee management, B, obsolete computer system, C, inexperienced personnel, D, large transaction volume, E, diversify and cultural differences, F, unfavorable climate condition or geographical condition. All right, so these are all the hazards. Okay, and then what happened is the event. So inadequate employee management. So what happened? For example, it will be internal fraud, okay, external fraud, okay, diversity, discrimination, improper business and market practice, inaccurate reporting, system failure, natural disaster. This will be the event. And then what will be the consequences? Write down loss of resource, restitution, legal liability, regulatory and also compliance. Okay, example fines, penalties, taxation, loss or damage to physical assets, and also others. Right? So this will be the type of data. So A is D1, D2, D3, D4, D5, D6, and D7. Then you have to measure, mitigate, and also monitor. So risk management is a process that allows individual risk, event, and overall risk to be understood and managed proactively, right? So basically the approach would be either risk avoidance, okay, which means that you try to avoid the risk, or maybe you do risk transfer, okay? Maybe risk transfer can be used, we can use, for example, takaful, okay? Or re-takaful, all right? And then risk retention and also reduction. Okay, all right. So retain the risk, or maybe you want to reduce the risk. And then we look at the risk management system, right? The risk management system and process. This one is a financial institution. So the 3 line of defense. Okay, we have the BIS unit, risk management compliance, and internal audit. Okay, so these are the 3 lines of defense. So we want to reduce the risk or we want to avoid the risk, we have these 3 lines of defense: BIS unit, risk management, compliance, and internal audit. Right, let's look at the body. Okay, for example, board. Okay, the board will see, the function is actually to see the overall policies, right? And duties and role is define overall objective and ensure the implementation by management. So this is the board of directors. Then the management. Management set up institution-wide risk management system. Okay, they have to set up the risk management system, identify the risk, and implement the objective and policies of the board. Okay, management kena ikut lah kata board. Okay, and then risk management department or unit. Okay, risk department pula kena tengok, identify and measure the risk. Okay, identify this risk. Okay, example, risk of fraud. Okay, macam mana nak measure kalau risk of fraud itu berlaku, what happened, right? So set up standards, limits, rules, guidelines, procedure related to risk. Publish various risk reports periodically for both current situation and expected future scenarios. Then from the risk management, you have the employees. Okay, and the employees you have to identify and control risk. What you have to do, you need to comply with the standard, limits, rules, guidelines, and also procedures related to risk. Then you have internal audit. Internal audit, we have the audit will actually monitor risk management processes and also ensure that risk-related guidelines and policies are followed and implemented at different level of operation. So internal audit will come, okay, every year to the branch, for example, and then see whether the employees, okay, follow or not the guideline and rules or limits that has been set by the risk management department. All right. So with that, okay, any question?
But fiduciary risk just now, I need more explanation.
Okay, fiduciary. Okay, what do you know about fiduciary?
I don't know.
Okay, fiduciary fiduciary ni macam dia dalam company, okay, a bank, fiduciary ialah maksudnya dia ada fiduciary, dia ada maksudnya ya, makan biskut.
Okay, Doctor. Okay.
Okay, tak apa.